Yes, well, the Wisetech story is pretty exciting. There have been some smaller, less profitable companies that have listed over the last 2 years, and there's been dozens of them, Bernie, and some of them may never really get the scale that's needed to be public companies. So there have been a few loopholes, companies using mining shells, of course, companies floating themselves, and they've usually been really too small and too early to be public, and they should have stayed private for a little longer. Some have succeeded and some have failed, but Wisetech is completely different from those types of company. It's a big global business with lots of revenue, lots of profit, lots of growth, and a justified valuation.
Philip, as you mentioned just before, recent reports suggest that some of these most latest tech fundraisings that have taken place on the ASX just over the past 12 months, around 40% of them have no revenue history, which I thought was a really interesting stat. And as Bernie flagged as well, we're seeing a lot of these backdoor and front door listings on the ASX, particularly through a lot of those clapped out mining companies. Is it right that some of these tech stocks are emerging from those mining companies? And do you see some sort of regulatory risk coming to light as a result of that? And what's the government doing?
It's a good and complex question. I personally don't think these small early stage companies should be in the public eye or on the public markets, and being on the ASX gives them a validation to retail investors that perhaps they don't warrant. As I've said, some have succeeded and some have failed, and the loophole in effect is a result of there hadn't been an active VC market in Australia until recently. Now that's changed with the change in Prime Minister and the growth of big funds like SquarePeg. But some of these funds were starved for cash, and the only way to raise a significant amount of cash was through the retail market and through these mining shells. I think there is regulatory risk because some of them will go down and some retail investors will be upset with their brokers. It's kind of eyes wide open though. The risks are there and they're stated in their listing documents. But I think we really should see these companies on a second board like they are in London or Frankfurt. And if Australia had a second board, this would be a better place for them.
Yeah, I don't know if that's a solution though, Philip. We've had a second board since 1999 here in Hong Kong. It's become something of a running joke, the growth enterprise market. And I'm old enough to remember the old club market in Singapore. I'm kind of wondering, do regulators need to do something like yesterday to get the market up to speed? Is there something missing that they weren't prepared for, that they didn't see coming, with these shell company, buy-ups and then, concomitant, listings and injection of assets? I mean, is this okay with the regulators? Are they completely aware of what's going on beneath their chins?
I think they are aware now. Some of these shells are not being used and reused anymore. The ASX has clamped down on them. But frankly, some of the companies going into the shells just aren't right or ready to be public. They're too small, and as Dan has said, pre-revenue in 40% of the cases. But the investors are aware of this, and the brokers are putting out the right documentation. It's probably going to be more of a market response than a regulatory response, because if enough of them fail, they'll start to get on the nose with brokers and investors and they'll die a natural death. But there's a brief window, I think probably till the end of the year, when this will continue, and the end of the year being the US election will probably slow the markets down a little, and then some of these more risky floats won't occur, but some of the strong ones like Atlassian on the NASDAQ and Wisetech, of course, here today, will continue on.
That's a great point. And I think it's also interesting just to pick it apart a little bit more, in the sense that, as I mentioned, we are seeing quite strong support for these tech IPOs from retail investors, but you're on the ground in Australia. How are you gauging the demand from retail investors when it comes to technology speculation and being exposed to some of this new risk, so to speak, given Australian investors are so, predetermined to being invested in perhaps the safer banks or traditionally mining companies?
The demand's there, but the demand is falling because these results have been choppy. There's been 40 or 50 tech listings in the last 2 years, and many of them are below their float price. So I think brokers now are probably only supporting companies that look like they're going to be profitable or global. Wisetech is clearly a standout because it's both and it's very large. But I think we'll see a reduction in the number and the rush of floats now in Australia, because investors have either been stung or they've seen other retail investors get stung. So I think Bernie, to your point, maybe the market will speak before the regulators, and these things may die a natural death before the end of the year.